everybody, Lance Browning with Income Solutions Wealth Management and Chandler Wealth Solutions. Welcome. So it's July, it's hot. That can only mean one thing. It's time for the halftime report. Just starting off, and in the interest of fairness, let's talk about what could go right. Corporate earnings, profits, could grow the right way without accounting tricks like share buybacks. This actually looks like it's really starting to happen. In my opinion, the vast majority of the earnings and kind of air quote here earnings growth from about 2010 through 2015 was from share buybacks. See, companies weren't making any more money. They were simply dividing their same profits by a lot fewer shares of stock. Again, this looks to be changing for the better. The economy could grow beyond the sort of 1 to 2% stagflation range we've been in for the last decade plus. Obviously, this would be a very good thing for the markets and for America as a whole. Lastly, what could go right is for the administration, Congress, and the Fed to coordinate monetary and fiscal policy. And you're probably chuckling as you read that, and I'm having a hard time saying it with a straight face, but it could happen. I certainly wouldn't hold my breath, but maybe, just maybe, the dysfunction in Washington, D.C. could stop long enough to do the right thing. If these three things happen, in my opinion, the markets could keep going higher. And that's certainly what the bulls continue to believe. So what could go wrong? The biggie, again, in my opinion, is the Fed. Jay Powell could cause a hard landing for the economy by removing stimulus. That's unwinding the Fed balance sheet, stopping money printing, stopping quantitative easing, and raising interest rates, all those things. You see, to be a bull, you have to believe that Jay Powell can pull off what none of his predecessors were ever able to do. Not Paul Volcker, not Alan Greenspan, not Ben Bernanke, and not Janet Yellen. Whenever they shifted policy gears from stimulus to de-stimulus, it caused a shock to the U.S. economy and to the stock market. Can Powell thread the proverbial needle on this? That's the question. Corporate earnings, profits could stay the same or actually decline without share buybacks, causing their price-earnings ratios to go back down to normal. And we'll talk more about that in just a second. The economy could continue stumbling along at 1 to 2% a year like it has for the last 10 plus years. This could cause people to rethink the valuations of the stock market. Washington, D.C. could continue with its dysfunctional business as usual, disconnected from the Fed and monetary policy. And lastly, a black swan event, geopolitics, global economic shocks, terrorism, war. There's always a possibility of something coming out of the woodwork, some wild card that we weren't looking for. So one of the things we're constantly doing is looking at risk factors for the economy and in the markets. So markets get into trouble when people buy stocks at very high valuations or prices. They do it with borrowed money, and they do it while the Fed is raising interest rates and or removing stimulus. So to quote the great philosopher Yogi Berra, the future ain't what it used to be. And this is called the Shiller PE ratio. So a PE, or price to earnings ratio, basically describes how many dollars in price we have to pay for the stock market in order to get $1 of profits or earnings from the companies in the stock market. And normally you would pay, down here to the left, about $16 to $17 in price for every dollar of profits the companies in the market earn. Right now we're currently a little north of $30, about 33-ish. That's almost double the norm according to Dr. Shiller. And Dr. Shiller won a Nobel Prize for Economics, by the way. In fact, going back past the 1880s, not the 1980s, we are currently at the second highest reading ever for Shiller's PE ratio. The tech bubble in the late 90s, early 2000s was obviously the highest. We are pretty much exactly the same spot we're in now that we were back before the crash in October of 1929. So Shiller's critics would say that he's overstating his PE ratios. Basically, that he's saying the market is more overvalued than it actually is. So here are 4 other market valuation metrics. If you average these 4, they're saying that the market is about 99% above its normal valuation. That's not a typo. Going back to 1900, that would be the second highest reading ever. The legendary investor Warren Buffett also has indicators that he uses. So basically, Buffett likes to compare the size of the stock market to the size of the entire U.S. economy. As time has gone on, these two numbers are normally pretty much the same. They're going to correlate very closely. Now, however, Buffett's indicator shows a stock market that is over 42% larger than the entire U.S. economy. Let that soak in for a second. Again, beating a dead horse, that would be the second highest reading since 1950. Hope this makes the point. Even the most bullish of investors will tell you that the market is very highly valued and really pretty expensive. The bulls just simply choose to believe that it will get more highly valued and more expensive. And they may be right. The data shows pretty clearly that people are buying stocks, though, at very high prices. This is one of my favorites, and many of you have seen this chart before. This goes back a little over 20 years. The blue line is the stock market. That's the S&P 500. The red line is borrowed money in the stock market. You can see the tech bubble here in the early 2000s, late 90s. You can also see the housing and everything else bubble in late 2007. Also notice that both the market and borrowed money in the market are much higher than they were in the previous 2 significant market drops. Please remember that borrowed money, unless you're the government, I suppose, borrowed money has to be paid back. When you borrow money to buy real estate and don't pay it back, the lender takes your property away from you and sells it to repay the loan. It's called a foreclosure. The same thing happens in the stock market, only we call it a margin call. A margin call basically requires forced selling of stocks to repay your loan. Margin calls are not good things. So we have investors buying expensive stocks with record amounts of borrowed money. And so here's another pearl of wisdom from Yogi. You got to be very careful if you don't know where you're going, because you might not get there. I love political satire and cartoons in general, and I thought this was really appropriate. So here's Janet Yellen, and now that's Jay Powell, chairman of the Federal Reserve, had taken the proverbial training wheels off of the economy, and it's letting it run somewhat on its own. We'll see how it goes, and we'll talk a little bit more about how rising interest rates have affected the market in just a minute. GDP stands for Gross Domestic Product. It's pretty much the bottom line report card on the U.S. economy. It tells us how much the economy is growing, or in some cases shrinking. I would consider an economy growing at 4% a year or more to be like an A on the report card. 3% growth would be like a B, 2% growth would be like a C, 1% would be like a D. Negative growth or negative GDP would be like an F. And the last F we saw was in 2008, 2009. Even going back to 2006, that's 11 plus years, the U.S. economy isn't exactly making the honor roll. Quickly, let's talk about S&P earnings by year. So earnings, the more publicly traded stocks earn, the better it usually is for stockholders, the market, and the economy as a whole. In my opinion, a lot of earnings, again, air quotes, growth from 2011 to 2016 was due to share buybacks. It's basically an accounting trick. We talked about this a moment ago, that when we listed the things that could go right. These corporate earnings right now, profits, are really, really going right. We'll see if they can continue and growing at the pace that they are. Here's what we call the S&P or LPL's earnings dashboard. That's S&P earnings. As you can see, earnings have skyrocketed in the last year or so. Does that become inflationary? As we asked earlier, can the companies keep this pace of earnings growth up. Now, the Fed funds rate is basically the Federal Reserve Bank's set interest rate. It sort of indirectly influences interest rates and the economy overall, but not 100% directly. You can see the big spike up in rates during that sort of hyperinflation late 70s, early 80s time frame. Remember those Paul Volcker whip inflation now buttons? Yeah. As you can see right now, rates are starting to go back up. The Fed is now raising rates. The VIX is a measure of volatility, the up and down roller coaster of the market. A lot of people call it the fear gauge. The higher the VIX is, generally the scarier things are. Inverse relationship. So when the VIX moves up, the market's usually going down. When the market is up, the VIX is usually going down. It usually pushes the VIX down. From about January 2013 until recently, the VIX was almost non-existent. It looked like an EKG on a potato. Fast forward to now. About February 2018, this year, the VIX came back, and it came back with a vengeance. That was when you would see these 1,200 point swings in the Dow on a given day. I would contend that volatility, as measured by this VIX, isn't getting very high. It's just starting to return to some semblance of normalcy. And as I said before, we talk about the effect interest rates have and what they've had on the markets historically. So here you go. From 1957 until now, you got about 50 years worth of data, about half a century. Here, you see where interest rates were at their low, then when they went and where they went up to from the low. This just shows on a total percent basis how much they went up. Lastly, here you see the effect those rate increases had on the stock market. Normally it was a 15 to 20% decrease in the market. Is Jay Powell, the new Fed chairman, putting the brakes on the economy? Stay tuned. Some of you from newer generations might like this quote a little better than Yogi Berra. Just when you think you've got the rat race won, they get faster rats. That's David Lee Roth. As always, we're going to continue to stay on top of these. Love to hear from you. Love to see you. Again, this is Lance Browning, Income Solutions, Chandler Wealth Solutions. Have a great rest of the year, great rest of your summer. Thank you.